Welcome back. Today, we're diving into a crucial topic for business owners, LLC versus sole proprietor. Which one saves you more in taxes? Let's break it down. This decision can save you thousands on your tax bill or expose you to unnecessary risks. Stick around, because I'm going to demystify all of this for you. Understanding the difference between a sole proprietorship and an LLC, especially when it comes to taxes, is fundamental. It's about protecting your personal assets and optimizing your tax situation. By the end of this video, you'll have a clearer picture of which structure might be the best fit for your situation. Let's get into it and figure out how to keep more of your cash. Let's start with the basics: sole proprietor and LLC. First up, the sole proprietorship. This is the simplest and most common business structure. If you start doing business on your own, you're probably already a sole proprietor by default. There's no legal distinction between you and the business. All profits are yours, but so are all debts and liabilities. It's super easy to set up. Often there's no formal action required beyond getting necessary licenses or permits. The beauty of a sole proprietorship lies in its simplicity. However, this simplicity comes with a significant trade-off: unlimited personal liability. If your business gets sued or incurs debt, your personal assets could be at risk. Now let's talk about the LLC, which stands for Limited Liability Company. An LLC offers liability protection like a corporation, but with operational simplicity and pass-through taxation benefits. When you form an LLC, you're creating a separate legal entity from yourself. This means your personal assets are protected from business debts and lawsuits. Forming an LLC requires filing articles of organization with your state and paying a filing fee. Many find these extra steps worth it for the peace of mind that comes with limited liability. Plus, having LLC after your business name can add professionalism and credibility. The first major difference is liability. With a sole proprietorship, your personal assets are on the line. With an LLC, the business is a separate entity, offering a shield for your personal assets. Another key difference is the administrative side. Sole proprietorships are lean, while LLCs require more formalities like separate bank accounts and meticulous record keeping. A sole proprietorship typically ends if the owner dies or stops the business, while an LLC can have a more continuous existence. To recap, a sole proprietorship is simple but risky. An LLC offers personal asset protection but requires more effort to maintain. Neither is inherently better. It's about understanding these differences before we get to the tax implications. Now, let's dive into how taxes work if you're a sole proprietor. The primary concept is pass-through taxation. The business itself doesn't pay income taxes. All profits pass through to you and are reported on your personal income tax return. You'll use Schedule C, profit or loss from business, filed with your Form 1040. Business revenue minus business expenses equals your net profit, taxed at your individual income tax rates. This can push you into higher tax brackets as your business grows. The self-employment tax is a big one. As a sole proprietor, you pay both the employee and employer portions of Social Security and Medicare taxes. This combined tax is 15.3% on your net self-employment earnings. This tax is in addition to your regular income tax. You need to pay estimated taxes quarterly to avoid underpayment penalties. As a sole proprietor, you can deduct a wide range of business expenses, lowering your net profit and tax burden. The Qualified Business Income (QBI) deduction allows many sole proprietors to deduct up to 20% of their qualified business income. The overall simplicity of tax filing for a sole proprietorship is often touted as a benefit. However, the self-employment tax can be a real killer as your profits climb. To sum up, profits pass through to your personal return, you pay income tax at your individual rate, and you get hit with the full self-employment tax on your net business profit. You can deduct business expenses and might get the QBI deduction. It's relatively simple, but that self-employment tax can be significant. Now, let's talk about how LLCs are taxed. LLCs are incredibly flexible from a tax perspective. By default, the IRS treats a single-member LLC as a disregarded entity, taxed like a sole proprietor. You report your business income and expenses on Schedule C, just like a sole proprietorship. The benefit is legal protection, not tax savings. For multi-member LLCs, the default tax treatment is as a partnership. The LLC files Form 1065, and each member reports their share of the income on their personal tax return. Members pay income tax and self-employment tax on their share of the profits. The real magic is that an LLC can elect to be taxed as a corporation. Most small businesses elect S-corporation, S-corp status for tax optimization. With an S-corp, the owner must be paid a reasonable salary, subject to payroll taxes. Remaining profits can be distributed as dividends, not subject to self-employment tax. This can lead to significant tax savings. An LLC can also elect to be taxed as a C-corp, but this usually results in double taxation. For most small businesses, the S-corp election is more relevant. To summarize, default for a single-member LLC is sole proprietorship taxation. Default for a multi-member LLC is partnership taxation. The game changer is the election to be taxed as an S-corp, allowing for significant savings on self-employment tax. This flexibility is a huge advantage of the LLC structure. It requires an active choice and understanding the implications. Let's compare tax savings, sole proprietor versus LLC, S-corp. Imagine your business has a net profit of $100,000. As a sole proprietor, this entire amount is subject to income tax and self-employment tax. The self-employment tax would be around $14,130. Now let's say you have an LLC with S-corp taxation. You pay yourself a reasonable salary, say $60,000, subject to payroll taxes. The payroll taxes would be around $9,180. The remaining $40,000 can be taken as a distribution, not subject to self-employment tax. This saves you around $6,120 in self-employment tax. Your total payroll SE tax bill is $9,180 instead of $14,130. That's a direct saving of $4,950. However, there are additional costs and complexities with an S-corp. You need to run formal payroll, which has monthly fees. Your accounting and tax preparation fees might be higher. These costs need to be subtracted from your potential SE tax savings. Generally, consider an S-corp election when your business net profit is consistently above $40,000 to $60,000 per year. At lower profit levels, the SE tax savings might be outweighed by the additional costs. Your salary should be comparable to what others in your field earn. A good CPA can help you analyze your specific numbers and determine a supportable, reasonable salary. For many successful small businesses, the S-corp election through an LLC is a powerful tool for reducing their tax burden. Let's bring it all together with some practical examples. Scenario 1. Sarah, the freelance graphic designer just starting out. Sarah is making about $30,000 a year in profit. For Sarah, a sole proprietorship is likely the best starting point. The potential self-employment tax savings from an S-corp election would likely be minimal. Scenario 2. Mark, the IT consultant, profits growing steadily. Mark's IT consulting business is netting $90,000 in profit annually. Mark should consider forming an LLC and electing S-corp taxation. The remaining $30,000 could be taken as a distribution, saving him self-employment tax. Scenario 3. Construction Dave. Dave runs a small construction business with higher liability risk. Forming an LLC for asset protection is almost a no-brainer. Scenario 4. Laura, the landlord with a few rental properties. Laura owns 3 rental properties. Using LLCs for liability protection is smart. Tax-wise, these LLCs are typically taxed as disregarded entities or partnerships. Beyond these scenarios, consider your tolerance for administrative work and your state's rules. The decision often comes down to a cost-benefit analysis. For liability protection, an LLC is generally superior. For tax savings, an LLC electing S-corp status can be better once your income reaches a certain level. Wrapping it up, your next steps. We've seen that a sole proprietorship offers simplicity, but comes with unlimited personal liability and self-employment tax on all profits. An LLC provides liability protection, and, with an S-corp election, can offer significant savings on self-employment taxes. The best choice depends on your individual business, income, risk tolerance, and future goals. The key takeaway is that you have options. Understanding these options can make a big difference to your bottom line and peace of mind. Don't default to one structure without thinking it through. Always talk to a qualified CPA or tax advisor for personalized professional advice.